Hello, we are going to the first lecture on fundamental analysis. Even though I introduced some ratios, we will be looking at the fundamentals of the company, how to go about thinking for some kind of investment decisions. So, first, a disclaimer, this is an education purpose webinar. I am not a SEBI registered advisor. Consult your financial advisor before taking any decisions on any buy or sell of a stock. We are not liable for any gains or losses made by you. The objective of this course is to spread financial literacy. This is the thing which we have been looking at. Fall from high, buy on strength, and verify whether the fundamentals are good. So if you're looking at good fundamental stocks, the fall from high can be around 10, 20, 30%. Once again, go back and check the fundamentals on screen or wherever you want to. 40, 50, 60% fall from high. They are good, but they are currently getting derated, and that is why the fall is there. Even some of the 70, 80% fall stocks may be good, but verify them. Anything above 90%, 85%, 90%, they are stocks which may have got severe beating in the market because of their performance may not be good. So refer some of the screeners so that you can have a look. So let us see now the rules for sound investing. Company which you are investing should be your market leader in that particular product or service, and the market share should increase over a period of time. How long can I hold? It is not possible today in current scenarios to hold it for the maximum period. Hold till the time you are getting the compounding effect. As soon as you are seeing that the particular business is not doing well, you can exit that particular company. Some disruptions do happen every year, and last 7 months we are seeing this, 7, 8 months now. Look at the sales, whether the sales are increasing, whether the profits are increasing, whether the stock prices are increasing. Is the industry growing or shrinking? There is a concept which is called as a pond and a fish. A fish which is in a small pond can grow up to a limited extent. A fish which is in a large pond can grow much more. But a large fish in a larger pond, having a largest market possible, they will be the ones which will be the market leaders of the future. I'll take this concept sometime, which will make you understand what kind of stocks you should look at. When I'm looking at FMCG company and I compare it with the IT companies, which one will do better? Not because currently the IT companies are doing bad, but over a longer period of time, IT companies do have an inherent risk. The risk is of the conversion from dollar. The risk is of the market not going for the business. The risk is of any war-like situation or inflation. They may reduce the spending on IT. Whereas in an FMCG company, some of the stocks will always be in demand. Though their consumption may reduce, though their package shrinkage is happening currently, package size, they may not be able to get good margins currently because of the inflation. But over a longer period of time, they can still face better compared to the IT companies. But it does not mean that the IT companies are very bad. They face some kind of challenge, whereas the FMCG companies, they face a different challenge. The challenge which the FMCG companies are facing currently are there is a lot of competition from the brands of individual companies. Like Tata's, they have their own brands. If you go to Grofers or whatever, the Blinkit now, they have their own brands. If you go to Amazon, they have their own brands now. So because of the e-retail kind of thing which is happening, the new brands are coming up. So HUL, ITC, they have a lot of competition, not only from their respective companies, but from these new retail companies also. So there are uncertainties in both the things. If you remember last year or so, FMCG was not doing so well. Now FMCG has started moving. FMCG is considered as a defensive sector, but very few companies in FMCG has moved. And if you have seen in the chart which I had shown you today morning, in that ITC has moved, HUL has moved little bit, and Britannia has just started moving. Godrej Consumer has moved, Tata Consumer has not moved. So what you see is that these companies, they are moving, but not all the companies in FMCG have started moving. The second rule is what we should buy, consumer durables or non-consumer durable companies. Now, some of the companies like food, soaps, healthcare, cold drinks. Now, Varun Beverages currently is doing well. Ice cream companies are currently doing well. Then we had the problem of COVID, medical companies were doing well, pharma was doing well. So look at the companies which are having higher turnover, fast, rapid turnover. So they don't hold on the goods for a longer period of time. The wallet size is small, low on wallet, high usage, short life. Like a soap is there for 2-3 days and the soap gets over in a family of 3 or 4. So continuous requirement is there. Turnover is high, sales will increase, profits will happen. Companies where population is one of the factors. So if the population increases, the sales will increase. If the company is offering non-durable products, then which kind of products you are looking at? Take the AC market. Only 3% of the Indian market is having AC, Indian consumers. Whereas in some countries, it is increasing to 30-40%, whereas we are only 3 to 4% now. So consumer durables, the wallet size will be costlier. Quality of the product is what people look at. Long lasting, 4-5 years minimum. The frequency of buying is once in 3 or 4 years. It is heavy on the wallets, costly on the wallets. Turnover is low. Inconsistency of sale is there. You may find just now, even though we have peak of the monsoon of the summer season, the most of the air conditioning companies like Voltas, Blue Star, Amber, that Dixon, okay, all they are not doing well because the companies' prices have gone up and the people are not able to afford. And another thing is there is a lot of competition. So the sales have become inconsistent. Even Voltas is not doing so well. You can see, remember the last result which was there was not so good. Maybe this April, May, they will do better compared to the last March result. Then see whether a company has a moat. A moat is nothing but some kind of a fort which is surrounded and will not allow the enemy to enter in. So is your business durable, long lasting? Is the product giving some kind of satisfaction, happiness? Will people buy the product even if it is 2 or 3% costlier? So if a company is able to maintain its competitive advantage, then those companies will always do well. Like Maggi was done well over a period of time. Nestle foods have done well over a period of time. There's no competitor in baby foods compared to Nestle. Soft drink companies are always doing well. Every summer, the soft drink companies are doing roaring business. Oral care, Colgate, media companies, Netflix. This year, Netflix has gone down because there is good amount of competition. Netflix is having, the pricing strategy was not proper. So they are saying facing competition from Hotstar, Sony Live, Woot, etc. Digital company service providers like Bharti, Jio, Vodafone has gone now. So economic moat has an advantage that they can pass on the cost, and the customers don't have major problem if the product is costlier. Like supposing I want to buy Nestle for my baby, I will be willing to pay 4-5% more also, but I will not take a substitute because I don't trust. Because for me, the baby is more important. They are growing consistently well. Economic moat is telling me the company is doing well. The customer is always satisfied. The product quality is always there. The sales of such companies will not get badly affected. They may go down a little bit. Okay, some consumption may reduce, but overall they will be still doing well. Like, let us see this, compare it with travel companies. They were badly affected during COVID. Price becomes a major issue. If they want to reduce their price, they will go in a financial loss. If they want to increase their price, they will lose the market share. So this kind of problems are always there with some of these service related companies. Just now, the hotel industry has started picking up. But once again, the stocks have gone down recently. You cannot always be sure whether because of your good service quality, you will always have a good inflow of passengers in your hotels or in your airlines. There is a lot of competition in the airlines companies also. Now that Air India is now a private company, so definitely it will start improving. Competition will increase. Akasa Airlines is coming from Mr. Rakesh Jhunjhunwala, and many other. Indigo is facing a lot of heat. Jet Airways is trying to come back. So airlines companies, hotel industry, travel companies, they basically are running with very low margins. And that is one of the reasons where many of them have to close down also. So where you will invest? Summary, the companies which will grow consistently, the products is always in demand, the companies which have coming up with new products and services, the companies whose products are good, predictable for sales, reliable companies, the durability of the products influence the rapidity in the turnover, how fast the turnover will have. Consumer durable companies, they are low turnover, inconsistent, low on profit, stocks prices get affected by the market changes. Non-consumer durable, high turnover, consistent sales, growing sales, high profits, stock price increasing. So this one page gives you an idea how to put your investment decisions. Now let us see some method of doing portfolio screening, how to select what I want to buy. First, we'll see if I'm having a stock of HDFC Bank. I had bought the stock at 700 rupees. Currently, it is at 1400. I think so it is at 1300 something. So I've taken 1400, downdated it. So what is the gain which I'm having? Return on HDFC Bank is from the exit price 1400 to the current price 700. The stock has grown by 2x. So it has given me in 2 or 3 years or 4 years time, a 2x return. So return on this stock is approximately double. Now return on investment is nothing but the exit price divided by the entry price. We are going further. Now what is a P? P is nothing but, P's ratio is nothing but the price of a share divided by the earnings per share. Now, if I take this price of a share and I take this earnings per share and I multiply with the P, P into the earnings per share, P into the earnings per share gives me nothing but the price of a share. So price of a share is nothing but the PE ratio into the earnings per share. So how the price of a share will get affected? In two ways. PE ratio is improving, and second is earnings per share is improving. Okay. Now, the exit price and the entry price, I will take it in the form of P ratio and EPS. See here, return on investment is equal to exit price. So exit price is EPS at exit and P ratio at exit divided by entry price, EPS at entry into P ratio at entry. Now, how will I perform? What decisions I can take? So earnings at entry and exit is going to make me one of the reasons of buying or selling a share. This is nothing but basically we are looking at the performance of a company. We are looking at the fundamentals of the company. So when I'm looking at earnings, I'll go to my P&L statement and I'll pick up the earnings from there, EPS. When I'm looking at P ratio, I'm looking at the perception, the market sentiments. Some people also call this as a perception to EPS ratio. It is basically based on the feeling in the market. You look at the technical analysis, you look at the chart and you are realizing your chart is going up, the prices are going up, the ratio is going up. You look at the price volume analysis on charts. So EPS, you are looking at the fundamentals. P, you are looking, basically you'll get the values from the table also, from the fundamentals table, but it is basically on the market perception. It is basically on the sentiments and the technicals of the product. It is basically on the price volume action. So as the stock price will increase or decrease, there are two possible factors. The price can increase because EPS of the share is increasing and the PE ratio is increasing. The price can decrease if one of this is decreasing. So price is the price of a stock will depend on the earnings and the PE ratio. So remember this, note it down somewhere. The price of a stock will depend on the earnings and the PE ratio. Now we'll see what kind of stocks. So here we see possible scenarios for investing and trading. And why I kept trading? Because many people do trading using this. Earnings increases. The earnings are increasing, the EPS is increasing, and the PE is also increasing. This becomes an excellent investment. The earnings are increasing, but the PE is remaining near about the same. This is a good investment. The earnings are increasing, but the PE is decreasing. The PE is decreasing, like just now in the case of Tata Steel. The PE is low, but the earnings are still high. But it is considered as an average investment because the perception, because the Tata Steel is not going to do well, is now taken the hit in this last 1 week because the government has put some kind of restrictions by way of customs duty. If the earnings are decreasing and the PE is decreasing, we should not invest. Both are negative. If the earnings are decreasing and the PE, here the PE is increasing, here it is decreasing. So when the earnings are decreasing and the PE is increasing, not so good investment. But if both are having something like a decrease and PE not changing, poor investment, and earnings are decreasing and the PE is decreasing, it is a worse kind of decision. So if you look at this particular criteria, D, E, and F, it is better in this kind of market not to go for it. When you see the PE is increasing, but if your stock earnings are decreasing, means only price is increasing because perception is there in the market. Okay. Now take the case of something like Zomato. Zomato has moved from 53 to 64 only by way of comments which has come in the market. The way from the top bosses, they have commented that we are looking at this kind of price rate at 130 and all. And people immediately started buying the stock. Many also asked me in this company, in this particular group also, whether we should go for this. We'll see Zomato now. Companies with A, B, C are good for investment. D, E, F, you should avoid them. For earnings, we need to study fundamentals. For P ratio, we can have an understanding from the perception based on the price action charts and volumes. P calculations are available on any of the websites. Let us see Zomato for getting ourselves satisfied whether we are doing something wrong or right. Zomato. Current price 62. Intrinsic value not given. Why? Because the returns are negative. You can see the returns are negative. The returns are negative. The ROIC is negative. Okay. So what do you see? The stock has gone up as high as 169. It went down to 50 levels. 53 was there a week before or few days before. Currently it is at 62. What is the sales growth? The revenue is increasing. Profits are negative. Pictures score above 6 is good. ये तो 4 है. See the price. See the P ratio. It is showing below 0. It is negative. See the market cap to sales. This is the market cap to sales. You can see. Where is the average? Average should have been here, around 60. What is the current value? Should I go and buy? Okay. Some people will still buy. Price to book value. See here, way below because the EPS is negative. The positives, debt-free company, that's good. Current quarter, it is expected to give better. It has given a little bit better, but the profits are still negative. Stock is available at a cheaper price below its book value, but the profits are not there. Please remember that. Interest coverage ratio is low. What does it mean? To pay back the debt, it is not in a position to pay back so because the ICR is how much? Minus 230. Minus means it is not having cash flows only. Let us see the cash flows. See here. Cash flows. As I told you, it is not having any money only. It is spending more than what it is earning. Investment activity, it is expanding. Investment purchase, investment sold, other investment items. So what is happening? Continuously, there is more amount of investment and there is no cash flow. Money is coming because some financial people are putting money. So we as retail investors, we should be a little careful. Where is any return on investment? Nothing. So see the profit and loss. Operating margin is negative. Profits are negative. Sales is 3611 crores and the profits is 52. The expenses are more. That is why the profits are less. The earnings per share completely negative. The sales is increasing. The profits are negative still. Stock price has not given any returns. अभी तो ये 5 and 10 का तो सवाल ही नहीं आता है because it is new company. Balance sheet. The liabilities and the assets. So when you see such a company, you should take a decision whether you want to go ahead and invest in such companies. Be careful. People do invest. Like they are normally all the big people who are having this kind of venture capital seeds function. I mean, in investments, basically, they are doing it, not us. Now, how do we improve our company's performance? What are the drivers? So we have these 5 drivers: sales growth, operating leverage, margins, reducing loan, inorganic growth. Let's see one by one. Sales growth. If the sector is doing well, the sales will do well. If the industry is doing well, the company will do well because it will have the tailwinds. The volumes are increasing, the market share is increasing, the company will do well. If you are able to increase the past prices, they will do well. If you are launching new products, looking at new markets, new geography locations, new business category, they will definitely do well. With the same infrastructure, if I'm increasing my new products information, new development, like Tata's, this Tata Neo, I don't remember the name, I think so it is New, NEU. This Tata digital product is going to be leveraging the Tata basket from one thing to another. Everything is going to be there on this. So whether it is Tata Chrome, Tata Trend, West side, all this, everyone is going to be on this particular Tata. Okay. So what you're looking at is the company is trying to leverage its operating activity, okay, by efficiently developing new capacities, new lines, new way of taking the business to the customer, efficient sourcing and purchasing. You must have heard about Tata 1mg kind of competition to Farm Easy and all these companies, NetMeds and all. So what you are going to see is there is going to be a tremendous amount of competition in the pathological labs. These lab companies are now going to severely face competition because Farm Easy, Tata 1mg and all these companies are now giving home service to you for doing all kind of lab related activities. So they are taking operating leverage to a level where earlier the companies. So you find Dr. Lalpat Lab and all this have drastically fallen, even though they may increase a little bit here and there, but overall the companies will not do so well, including Thyrocare and all. Margins. Another way of improving the growth is through margins. By reducing the costs, reducing the expenses. So we are looking at increasing our margins. If we are able to do business process re-engineering processes, like the car companies are coming out with EV, where the major part is only the battery part and all other parts and components will get reduced. So overall the margins will improve. Once the battery price comes to a normal value, we'll find the car margins will also improve and they will lower the price of the EV products. So new products are coming with better margins. Definitely it will improve the earnings growth of a company. Reducing loans and debts. Most of the big companies like Tata Steel and all those heavy asset companies, they have started restructuring their finances and loans and they have started repaying the debt, including Reliance. Inorganic growth, mergers, acquisition, formation of joint ventures, formation of project-based joint venture companies. So for any one like BPCL, just now, this particular company sell-off has been put off, means abhi nahi hone wala hai. The reason is because they were not able to get the right kind of companies for the sell-off, because nobody was willing to come. And now we are seeing that so many chemical companies are shifting to EV battery manufacturing. All this is happening because people are looking at different ways of manufacturing businesses, having some leverage, moving into some different business areas. So Tata Chem is one of them which is moving. Tata Power is now moving from the regular power to the green power. Adani Green Power is doing well. So how do we ensure profitability and growth and long-term sustainability? These are very important things. Growth will depend on the two things basically: the profitable the company should be and how long the compounding effect should happen. If I am having a company which is there for the next 10 years, 5 years, then definitely my company will do well and my portfolio will also do well. So look at earnings growth, companies which are not only growth, but long-term also they are going to be available. Gross profits are good. Net profit after tax margins should increase. Profitable in the longer period of time. Long term is a very important thing. It is not that 1 or 2 years I'm good and then next afterwards I will go down. Continuous increase in the net profit margins over the period of time. is what we should be looking for fundamentals in a company. Now here are two ratios which I'm going to just introduce. We'll be doing these ratios little depth later on, but just now I'm introducing because I introduced two things today, PE, and made you understand about the earnings per share. We'll be doing those PE things once again when we do valuations. So revenue is minus the cost of goods sold gives me the profits. So sales minus the expenses gives me the profits, gross profits. From the gross profits, if I remove the operating costs, if I remove the depreciation and amortization, I will get something called as EBIT, earnings before income and tax. Now, capital employed is defined as total assets minus current liabilities. That is one definition. Another way people look is net working capital plus the fixed assets. And the third is total equity plus long-term liabilities. Now, I don't want you to become accounting experts, but I want you to understand how to use the ratio. So ROCE is nothing but this EBIT divided by this capital employed. And that value should be in the range of anything minimum 12 to 15%. 17% is a good level. 12 to 15 के ऊपर ही होना चाहिए. That means your company is giving you back. Growth is important for every company, and the cost at which you are growing is also important. The cost should be in control. Okay. The opportunity cost is nothing but the money I am borrowing so that I am in a position to grow, including my own financial investment as an investor. If I've invested in my own company, I should be able to recover that. So your money ROCE should be much, much more than the money you are invested. If I'm having an ROCE of 8%, 7%, I might as well invest in FD. Why do I have to run a company? If ROCE is above 15, 17%, it is good. Minimum at least should be at least 12%. If you remember in our screen also, we have taken 15%. So what is a good ROCE level? Okay, approximately it should be in terms of equity, it should be above 15%. Some debt heavy companies, they have debt of 9 to 10%. So your ROCE should be more than what your debts are. Sometimes I'm not getting the money, I might as well close my business or try to reinvest in some other line. The ROCE should be higher than the cost of capital. If the cost of capital is say 7-8%, then my ROCE should be much more, because then only I will be able to recover. The companies strive to achieve an ever increasing ROCE over the years. It indicates to me that the business is stable. So at least 12-15% to hona hi chahiye. In the one of the books which I forgot the name, Peter, the book is one street on the wall or something. He has mentioned that up around 17% is a good price, good value for ROCE. Now, supposing I'm having two companies, A company and B company. One is having a ROCE of 18%, another one is having a ROCE of 25%. Now, which is the company I should be investing? All other parameters are similar. Long-term growth prospects are similar. Whether I should invest in 18% company or 25% company. So if I'm investing in 80%, I'm expanding my existing business. If I'm going to get 25%, I start something with similar business. So if you are the owner of the business, you may select point A. You may select business A. As an investor, I will go for business B. It depends on you. Future growth and ROCE values should be considered when evaluating a business or looking at the new opportunities. ROIC is very similar to ROCE, but you are looking at only how much investors are putting in their money and how much returns they are getting in. So if I'm an investor, and how much the company is making money for me is important. So ROIC is the subset of the overall capital invested. So invested capital and ROCE में से मैं capital employed में से ROIC I am able to find. How do I do it? Net profit I consider. Income minus the dividends. Divide by capital employed. The base is the same. Only thing I subtract the dividend. So income minus into tax rate EBIT upon divide by capital. So this is the formula we use for calculation of ROIC. Which one I should use, ROCE or ROIC? If the ROCE is greater than cost of capital, 12%, 15%, I'm doing well. If ROIC is greater than 0, the company is profitable. But if both are opposite, the company is not doing well. ROCE is less than the cost of capital, means my money on the capital is much more than the money I'm getting back. Or my ROIC is negative, I'm not able to earn anything out of it. So what does it mean? The company has invested money, but they are not getting a proper returns on that particular investment. So investment has not got any kind of proper returns. ROCE is based on pre-tax and ROIC is based on after tax. So company's perspective, we are looking at ROCE. From investors' perspective, we are looking at ROIC. When I'm looking at companies in different countries or tax systems, because the tax systems are different, I will prefer to use ROCE. So when I'm comparing companies across different countries or different tax systems, I will use ROCE, not ROIC. When I'm having a look at companies within the same tax system, then I may use ROIC also. So this is what I was supposed to do for today. Okay. Anything you want me to help you out? So we will introduce new concepts. Next time I'll be showing you profitability ratios and growth ratios. Then after that, we'll take the return on assets, return on capital employed, ROE. The one after that on valuations. So that is how we'll be seeing the fundamentals. Any questions?
No, thanks, Vira.
Okay.
Thank you.
Anyone else? Let's close the day. Okay.